And thank you, Fintech Saudi, for allowing me to speak today about SME finance. Just a quick background on myself and Al-Raida. Al-Raida was established in 2014 in Saudi Arabia to finance SMEs. We received our license from SAMA in 2016, and we continuously support SMEs. We're 100%. We finance SMEs 100% of our portfolio, and that's our focus. And we use alternative finance models to finance SMEs. So this is a good segue into the presentation. I have 20 plus years of finance experience, both in the US, UK, and Saudi Arabia. I've been located in Saudi Arabia for the past 14 years. So enough about my background, and let's get into the topic of alternative finance models, SMEs, and the benefits and how we can all succeed to support the Saudi vision of greater participation of SMEs as a part of GDP, and where we can go and how we can move this forward. So what we're going to talk about today is, obviously, we're going to talk about the importance of SMEs. What is alternative finance? How finance was historically delivered from banks and other financial institutions before fintech really caught hold. Also, we'll talk about the impact of the financing models. We'll specifically talk about POS financing and MCA, merchant cash advance financing, new trends and opportunities, AI and machine learning, which is a very hot topic ever since ChatGPT has been released. And then we'll take Q&A. I want to leave as much time as possible, so get your questions in, like Sagar has requested, in the Q&A section. We will answer as many questions as we can, but I'll leave as much time as we can as well to answer all of your questions. So SMEs in Saudi Arabia obviously have a very important piece of Saudi society and society as a whole globally. And when you look at SMEs can be defined very simply based off of revenue and the number of employees. Usually we like to go off of revenue. It's a pretty straightforward indicator of SMEs. And when we talk about SMEs, we're not just talking about small and medium enterprises, but we're also talking about micro businesses. 80% of the Saudi SME sector is micro businesses. Micro businesses are entities that have between 1 riyal and 3 million riyals of revenue generation, and small businesses have between 3 and 40, and medium-sized businesses are 40 to 200 million. And these businesses come in all shapes and sizes. Everywhere you go, you deal with SMEs, from coffee shops to restaurants to pharmacies and other establishments. Some of your friends, family may own SMEs. People on the call maybe have their own SMEs, and this has taken various shapes and forms. It's no longer just brick and mortar. There's a huge online presence of SMEs in the kingdom as well, either utilizing tools like Noon or Amazon, Zed, which is one of our partners, or Sella, to open their online stores to be able to sell. And still, the hardest part for SMEs, obviously, once they've gotten started, is the capital requirements that the SMEs need to maintain their business and to continue moving forward. And as part of our initiative, we've developed, and the market has developed, many different resources, Fintech Saudi being one of them. You have SAMA, Moonshot, CMA, the Social Development Bank, the newly formed SME Bank, the Ministry of Tourism, the Ministry of Culture, and the Ministry of Agriculture all have support programs for SME. And they use the alternative financing models to deploy this capital into the market, using the likes of Lendo, For Us, Arakmiya, and other MBFIs and other alternative financing solutions in the market to help distribute that capital across many different SMEs. So when we talk about alternative financing models, alternative financing models is going to cover everything that's non-traditional. And when I talk about traditional, I talk about when you go to the bank and you look at and you request financing for your business and they ask for financial statements, 3 years of business operations, the collateral maybe between land or other types of collateral vehicles, etc. So this is typically what has always happened in the market, and a lot of people have been left out of the debt financing market using shadow banking to get financing in an unregulated form, one way or another, to support their business and continuously support their business. And new models have opened up. As you can see on the screen right now, you can see a few of these different types of models. And you can lump the first two together, crowdfunding and peer-to-peer lending. Like I said before, Lendo, Rakmia, and For Us are peer-to-peer lending platforms that are newly established in Saudi Arabia over the past couple of years. But you also have, outside of Saudi Arabia, many other forms of peer-to-peer lending. You have peer-to-peer lending that supports the lenders themselves in Mintos in Eastern Europe. You have then personal lending, credit card lending, and other forms of lending through Funding Circle or Lending Club in the US. So you look at these different sources and different types, and they all have a different strategy to get people that are not necessarily eligible for financing eligible in one way or another. That eligibility comes at a cost, but that cost fails in comparison to the ability to actually raise money and continue your operations and move forward. When you look at angel investing, that's more of on the equity side. You have invoice financing or invoice factoring. This is a great solution for those who work with large institutions that take time to pay, because what you're doing there is that you're actually offloading the credit risk of your SME onto the larger institution who will actually pay directly to the lender, which will allow to open up more working capital and to help you expand your business much faster. And then you have asset-based lending, collateralized either by inventory, equipment, or receivables. And then you have revenue-based financing. And revenue-based financing comes also in different shapes and forms. So as we discussed before, as I mentioned before, merchant cash advance financing. Merchant cash advance financing is very simple in its terms and very complex operationally. Merchant cash advance financing is something where a lender would look at your sales volume from your POS terminals or sales volume of your online sales and take a relationship between how much they can lend you based on that sales. And then basically the SME would agree with the lender that a certain percentage of all their sales would get paid directly to the lender through the payment processing provider, if it's online, or through a payment aggregator or a credit card company today like Jidia or Shore, who are in the market as well. So this is a very interesting opportunity, and we'll get into it deeper because you have a lot of large, what we would call non-typical financing companies emerging in markets. So what you can look in, and I refer to the US a lot, my background is there as well, but you can look across the globe and you can see different types of these companies. If you look at Square or now Block, you look at PayPal, you look at Shopify, you look at Amazon. All of these companies in one way, shape, or form use revenue-based financing to support the SMEs within their platforms. And they're some of the largest financing companies in the world. I think at the end of 2022, Square or Block funded $4.4 billion worth of SMEs through merchant cash advance financing. And merchant cash advance financing isn't relatively new globally. I think it was launched back in the 90s in the US. There's over 2,000 merchant cash advance companies in the US today, but it's expanding out to other parts of the world. based on changing regulations, the ability to partner with payment companies, and in that sense. So SMEs have a big challenge. SMEs and micro SMEs are challenged by cash flow and managing cash flow. They're very small and traditional type of businesses that need to get financing, and they're running their business every day. When they're running their business every day, their last thought is, at the end of the day, is where's the cash going to come so I can fund my inventory for tomorrow? And usually when they're coming and asking for money from an alternative lender, their first thought is how fast I can get the money. Their second thought is how much can I get? And usually their last thought is price. If they're price sensitive in this market, they probably will go and try to attempt to go to more traditional financing sources like banks and that such. In some instances, like invoice financing or invoice factoring, rates are typically lower for SMEs and the cost is lower for SMEs because the lender is not taking the risk of the SME, but taking the risk of the larger entity. And that larger entity in Saudi Arabia can be SABIC, can be Aramco, can be these large organizations, STC, and those payments will be coming directly from them because the SME has already provided a service to that company. And I think Lendo, Forest, and others have these invoice factoring and invoice discounting lending products in the market. And then usually they're discouraged by the lengthy application process. Some of it is warranted, some of it is not. There's a lot of companies that are coming into the market today to help with the onboarding, KYC, AML checks that are required by the central bank to make sure that we keep a very sound financial system and that we provide the best service possible. So financing will allow SMEs to grow their business, create jobs, and actually develop their communities, right? Everyone, for the most part, will shop SMEs through their local community, in their local communities, because that's where they live, that's where they do most of their shopping, and they support SMEs in their local community. And obviously there's other platforms in the market that help expand the reach of SMEs, including the online platforms, Jahez and Hunger Station, for them to sell across to larger groups of people and to help become more efficient. But even with the Jahez and Hunger Station, there are financing options that we use through these entities. We currently have relationships with Noon, Jahez, Zed, and others that help us facilitate lending where lending normally isn't given. With that, we take extra risk and grow and help support grow those SMEs into larger companies. We like to see, obviously, SMEs that come back to us multiple times growing and seeing that their branch network of coffee shops or restaurants have expanded and in that support. And the reason why I say that pricing also isn't necessarily the most important factor is, and I'll give you an example of one. If you have a branch of a restaurant today, and that branch of your restaurant today is netting 1 million riyals of net income every year, maybe not 1 million, maybe 500,000, and you know that, and you're in the north of Riyadh, you know that people from the south want your service and you want to open a second restaurant. If I offered you, without telling you what the rate is today, if I offered you financing today and said, listen, I'm going to give you this financing today, and I want 100% of your net income to open that branch over the next 3 years, the resounding answer of those SMEs should be yes. And the reason why it should be yes is that after 3 years, the financing entity and the financing company leaves the the SME, and they didn't have to take on any equity investors or dilute their shares, but they've doubled the size of their organization, and they can double the size of their income within a 3-year period without even telling you what the rate is. Even if the rate was 30%, 40%, you would then double, and then the value of that money has doubled as well for you. So when you look at alternative financing, usually alternative financing, with the exception of invoice discounting, is usually higher priced than the banks. But the question is the availability, and how do we make it more available, and how do we make it more accessible? So on the landscape, you look at new investment opportunities. We want to promote financial inclusion as fintechs for others. We want to promote innovation and entrepreneurship, and access to capital becomes a very important part of that journey. And over time, this will help expand the reach of SMEs, the growth of SMEs in the current market as well. If you look today, I think there was I saw a press release on Arab News, I believe, that there's 1.2 million companies that are licensed in Saudi Arabia, and recently 80,000 new SMEs that have launched in Saudi Arabia as well. Over, I can't remember what period of time, but 80,000 is significant. That 80,000 has contributed to job growth, has contributed to the economic diversification of the Saudi market. And also with that growth is a good opportunity for alternative financing companies and fintechs to come into the market and service these entities. And we're talking about alternative financing models. Alternative financing model doesn't necessarily need to start with financing. It needs to start with a relationship. That relationship can be a payments relationship. It can be an electronic cash register relationship, or it can start with a financing relationship. When I talk about Shopify, Block, and the others, all of these entities that are coming on board, they never started out in financing. When they wanted to grow their business, they started out with payments. They started out with electronic cash registers, and then they expanded into financing. It just so happens we're doing the exact opposite because there's additional complexity to lending. That complexity is the risk that you're going to take. Now, some of the alternative finance lenders take risk on their own balance sheet. Other alternative lenders do not take their own risk on their own balance sheet, and they allow others to participate in the financing of these entities in a controlled fashion. And if you look at Beehive, Forus, Lendo, and Rapmia, they all do this through their peer-to-peer lending platforms. And I'm sure a lot of people who are on this on the webinar today have used one of these platforms in one shape or form. So POS financing, very simply, we look at your POS sales, we discount your cash sales, we give you a percentage of those sales, and then we expect a percentage of those sales to come back to us until the payment is done. This is one model. This is the model Block uses for offline. This is the model Shopify uses for online. The way we look at it is that we want people to use this within their business. We want them to grow their business. We want them to launch marketing campaigns, renovate or expand their locations. And it makes it a very simple process. And when you look at POS financing, why do I think it works very well for SMEs as an alternative? If you have invoices, invoice discounting is a very good alternative. If you don't have invoices and you're a restaurant or you're a coffee shop or a pharmacy, when you look at your cash flow is not stable. You have periods of time and seasonality in the market. And the seasonality is either, for some industries, is good during those times or bad. If you look at different regions in Saudi Arabia, you have seasonality. If you look at the summertime, EBHA has good seasonality. People travel to EBHA, visit EBHA, sales in EBHA are higher. If you look at Ramadan, you look at Eid, certain industries like restaurants, sales will go lower. If you look at the summertime and people are traveling outside of Riyadh, you see sales are going down. So you cannot always make the same payment every single month. But the solution of point of sale or merchant cash advance financing allows you to match your cash flows as an SME and the cash flows expected from the lender without being pressured for payments over time and fixed payments over time. So basically, it's a win-win for both the alternative lenders and also the SMEs. So you can focus more on running your business and less on worrying about receiving payments or paying your lenders. So I jumped straight to Square, and I've talked about them for a while now. So Square, obviously, if you don't know, started off as a electronic cash register, moved into payments processing, created the ability to connect your mobile device and take credit card payments. And this helps significantly SMEs and MSMEs in the market today. That process then allowed Square, with all of the data they were able to capture, to underwrite customers very quickly, understand the seasonality that they see in their businesses, and provide valuable insights into that market. That market lends a very clear in the restaurant business to merchant cash advance financing. And it's not just restaurants, it's coffee shops and such, and other retail establishments. And with AI and machine learning, data becomes a very key aspect of how alternative lenders make decisions without the need for financial statements. Alternative lenders don't necessarily take financial statements because, one, of the amount of data alternative data they want to collect from alternative sources. Most restaurants today have Google reviews. Most restaurants today also have other platforms where they're rated, reservation services, etc. So you can see a lot of information that would make you as a lender feel very comfortable. And you know the size of that location, you know the sales per square foot, and it all leads in. And without machine learning, it would be very hard to take this much data and compare it over time. And like I said, I think at the end of 2022, Square lent about $4 billion worth of SME loans. Now, every single customer in Square may not actually be eligible, and I think their penetration of lending to their core market of payments services is about a total of the 10% of their platform. So it's a very small portion of the platform, but probably one of the most profitable portions of their platform. With that being said, there's a lot of risk of holding assets on your balance sheet. And as you get into a more developed market, there will be alternatives and investment opportunities for the investment companies to come and participate and buy assets, as Square usually sells off the assets off of their balance sheet, but retains the management of those assets. When you move into peer-to-peer lending is a very interesting subject, because usually the peer-to-peer lending companies don't necessarily use their own balance sheet. They use a very streamlined and efficient onboarding process through their mobile application or web applications. They also use their underwriting capabilities and data as well to determine the credit rating of these micro and small businesses and the amount of money that a company can borrow. Once they identify the company and the opportunity, they place it in a marketplace, and those who have registered as investors in the marketplace allow for those investors to share in the risk of lending to these micro and small and medium enterprises. Over time, as Lending Club has grown, and they're moving more to a banking model, and it's a good entry point. A lot of these alternative financing and services and fintech models all push these companies closer and closer to digital bank. And why do I say that? Because what do banks do? The banks have customers, the banks take your savings and lend it out. So if you look at Lending Club or any of the others, without taking the balance sheet exposure, without taking the duration risk, they go out and find the investors to take that opportunity. And it's your choice as an investor to decide whether you want to invest in this opportunity or not. This has given a lot of financial freedom to people and investors, not having to rely upon the bank where you put money into potentially a savings account or a checking account with very little or no return. However, there are a lot of risks associated with peer-to-peer lending. Peer-to-peer lending is if the company that was lent to doesn't pay through the peer-to-peer lending company, and they're unable to collect on behalf of its investors, you lose your capital and you would lose the profit going forward. So this is a very big challenge. I'm not pushing anyone to go into peer-to-peer lending to invest. However, you should do your own research in regards to how much risk you're willing to take in those cases. But the reality is that you have opportunities now that were not afforded to us before the fintech release. So as we've been saying, the market is huge. The Saudi market, the global market. If anyone starts off their speech talking about SMEs, they always talk about this huge funding gap. This funding gap has been there forever. There is more than enough space for people to grow in that fintech space to support SMEs, whether through payments, cards, wallets, lending, other services. And again, they tend to be the most needing of this support. There's a lot of stuff we can do in fintech with all of the new regulations coming out. There's new buy now, pay later companies coming into the market to support B2B services, not just business to consumer. We also have the fintech sandbox from Sama to help support your initiatives in the growth of the fintech industry in Saudi Arabia. And it's very important that we use all these resources and support these resources to grow our opportunities here. And the other thing is partnerships. A lot of the stuff that we've been able to do as a lender, as a fintech lender, is partner with other fintechs in the market, partnering with payment companies, partnering with ECR companies in support of this. And this is only going to lead to more opportunities as open banking becomes more prevalent in the market. Open banking, as it is portrayed to be, is very important because of the ability to gather data. Today, if I want to get banking information or information from an SME's bank, it's very challenging to get that information without this open banking framework and the need for open banking. So it's going to uplift the alternative financing market to a higher level, and also that is very inclusive to the SMEs, and it should bring down a certain level of pricing because of the access of data. Credit scoring is very important for SMEs. How do you score? How do you determine whether a person is creditworthy or not using alternative data? It's very difficult because a lot of SMEs, each person's facts and circumstances are pretty different. If you look at the facts and circumstances of lending on a personal loan level, it's very straightforward. You have a job, you have an end of service benefit. I get your data, I calculate 33% from your debt provisioning for a bank. This is how much I can lend you, and thank you for assigning your salary. From a financing perspective, same thing. I could go to 45%. Thank you for paying me a portion of your salary. For SMEs, it's not very straightforward. There's a lot of different information. There's a lot of commingled data with personal data. There's a lot of changes in the market. There's so many different factors, within each person in each industry, that you need a robust platform to analyze the data. You cannot do this on your own. What we've done here in Alrida, and I know others have also signed up for these services, is a long time ago, back in 2000, I believe in 18, we started our journey on AI and machine learning because we knew this was going to be a very, very important opportunity. And while we were early to the market and an early adopter, it helped us in a way that we didn't think it could help us. It helps us really structure the data. You can't just take random data points. You need structured data in a way that's easily identified and identifiable and able to assess trends, multiple trends, usually multiple models over a period of time. And the first thing we did with this was to determine the probability of default. When you look at a customer, what is the probability that they're going to default? Based on that, not just the question of when and how, but how long will it take them to default? Because obviously, if you give the same loan and there's a good percentage chance that they're going to default, it matters if the default happens in month 1, or it matters if the default happens in month 36. People are probably still lending to the customer who's going to default in month 36. People are not going to lend to the customer or the SME that will default in the first month. So you take these big, large models, and you have to assess which model is appropriate for what you're trying to solve for. So instead of hiring a ton of data scientists, what we did was we partnered with Data Robot, which is an automated machine learning platform, which I believe some of the banks have already subscribed to as well. And they actually supported us in the sense that they have the data scientists. They've done this. Lending Club was one of their first accounts. So we had some history to go off of how they supported the financing of SMEs in certain markets. And when you're looking at that, it needs a lot of data. So on day one, when you launch your fintech, these machine learning platforms are not going to necessarily help you immediately. They will help you over time. But the most important thing is to make sure that you're structuring the data correctly, that over that time frame that you're going to be able then to use that data on these platforms to help grow your business and identify points of risk, identify points of opportunity. Thank you, everyone. Hopefully I've given enough time for questions and answers. I can see that there's around 57 questions, so I think we have enough time.
Yeah, we're going to keep you busy, Paul. No, thank you very much for that. That was an amazing presentation. Loads of really good insights and content into that. And yeah, we will definitely share the recording so people can go back over this and the slides just to make sure that everything can be digested. We do have a lot of questions coming through. So I'm just going to sort of try and group the questions a little bit. But firstly, let's start off by talking about SMEs. Why are SMEs so important to the kingdom? Why is there so much focus in the kingdom on SMEs right now?
I think it's twofold. I think it's diversification away from oil revenue, and additionally to that, I think it's an employment opportunity. And employment opportunity is very important in society. It helps uplift society as a whole. It gives opportunities to grow, and also it gives an opportunity for young and old Saudis to start their own business, become entrepreneurs, and bring their own direction to themselves.
And going back to the sort of the question of why they need finance, you covered that in quite a bit of detail. But is there sort of, from your experience, where are you seeing the most growth? Is it around growth of their businesses? Is it around working capital issues? Where are they typically looking for finance?
We see it in some as an expansion of the footprint of their current store because they see opportunities in the market. We also see it as working capital facilities. I think some of it is also debt consolidation. They want to consolidate debt to make it easier to pay. What we do notice though with SMEs is they tend to ask for the maximum amount of financing available and not necessarily assess what they're actually looking for. So we're looking at building tools today to help them assess how much they actually need, because when you start taking too much money, while you feel the comfort that you have the money today, it costs a lot of money. So that cost is not having the same return if you were going to put it to work in your business.
And this leads on pretty nicely to my next question, which was around education for SMEs. So you mentioned sort of that really interesting point that you should actually be quite interest rates should be quite less sensitive for SMEs, because if you can grow your business and double the size of your business by giving someone 3 years of net income, that's a great deal to look at. But is there a level of education required for SMEs from alternative finance providers to explain how their model works and explain how SMEs can get the best out of that model?
I think, listen, I think the whole thing around pricing and price sensitivity, everyone wants to feel like they've gotten a good deal. And I think it's been ingrained in our heads, both here and abroad, that price is the most important thing. But if you can't get the money, you're not going to be able to run your business, and you're not going to be able to continue on and move forward. So the education process of how and why, and the value of what you're getting is really an interesting thought. The people need to one, compare. There's a lot of alternative. I would love to say, listen, everyone should come to Alright, and that's great, but you guys should all compare your opportunities. When someone comes to us, comes to us and tells us, listen, I have 6% from such and such a bank and you're charging me 12. My first response, and I tell my sales guys this all the time, I'm not sure they listen, send them to the guy who's giving them 6%. If they're really going to get the money at 6%, they should take it. There's no option, like this is it. However, depending on the speed and the need, that education process is somewhat learned on the fly. It's not necessarily something that you can ingrain, because you may lose the deal tomorrow. And if you lose the deal tomorrow, you may miss the next deal because you missed the first deal. So it's very challenging and very interesting at the same time.
What are the other challenges you face when lending to SMEs? So what are the sort of typical challenges that our readers facing and other alternative finance would be facing?
So a lot of the questions, that the hardest part up front for us is to identify the ultimate beneficial owner, right? So from a lending perspective, it's important to know who the actual owner of the establishment is. So it's very challenging in that sense to find the ultimate beneficial owner. The second piece is obviously capturing all of the data in a very timely manner. So with open banking, that bank statement analysis that you're trying to do will take seconds, not hours, right? And giving you more feedback and more information to make a decision very quickly. Where we struggle sometimes too is sometimes we don't get the whole story. And credit is sort of like a story of how, why, and why I need financing, what am I going to do with it, and stuff like that. It's very good to be upfront with your lender. Sometimes people feel giving too much information will lead to a no, but it goes to credibility. And whether you're a traditional lender or a fintech lender, you always go back to the 5 C's of credit, right? So I think that goes a long way.
What are those 5 C's of credit?
Oh man, you're gonna collateral, capacity, credit history, and what's the other one? Collection and one other. But those are the 5 C's, because one or two of the 5 C's fall off in credibility. One of those 5 C's, like collateral for us, is not important. Collateral for us it may mean a lower rate, but we're not requiring people to bring collateral, right? Traditional lenders require collateral. If the risk is too high, we may offer collateral to reduce pricing, stuff like that. But again, there's a lot of opportunities in this market to lend.
So I mean, if you're not asking for collateral, so just explaining that you're not asking for any physical goods to which you can secure your loan against. So if that loan defaults, what is your recourse? How do you get your money back typically?
So well, listen, if everyone does what they were supposed to do, and we did our underwriting correctly, and we gave you the right amount of money, and we have one of our partners install the POS terminals in your shop, then the expectation is that we will collect our money through the POS terminals. One of the challenges that we face is a lot of people change their POS terminals. A lot of people move their POS terminals, and this is not uncommon. So in the US, you'll see a small business that has 4 POS financing loans and 4 different POSs on the counter. So you know, whether it's a fintech or a traditional, we all have the same overall issues with collection. Nothing becomes that easy that if it was, everyone would be doing it.
Is there also a higher operational cost element to this as well? So you talked about having to look at alternative data, really understand the customer really well, and then you've got the other part around collection as well. So do alternative finance lenders have a higher operational cost of lending to SMEs than banks, for example?
I don't think necessarily it's higher. So it's not higher operational cost, it's higher risk. So when you underwrite, like when you underwrite an MCA loan, typically banks underwrite credit risk. When in an MCA or merchant cash advance financing or revenue-based financing, and even invoice factoring, it becomes not just a credit risk, it becomes a duration risk, the length of how fast or how slow you can get paid back, because we made our payment terms so dynamic that if you keep collecting 25%, but it goes past 1 year, the expected return goes down, right? If you pay faster, your sales have gone up, so you've prospered from increased sales, and we've prospered by getting paid back faster. So you're taking more overall risk on the market. And again, from a speed perspective, we're definitely faster, and most alternative financing companies are faster than banks. So the speed component then leads to more risk. So I wouldn't say it's operational cost. There is some operational cost around reviewing bank statements if that's what you do. But then once we get them onboarded, now we have, instead of waiting for bank statements, we get all the payments data. So we see how they're performing from a payments perspective. It allows for early intervention to support the SME. Maybe the system's not working. Maybe their branch is closed for renovations. So we were able to monitor and move very quickly to remediate the repayment and get them up to speed. So it helps in that sense of collection. Before, if you're a traditional lender, you wait. Usually you pay on a monthly basis, quarterly basis. You wait to see if they're going to make the payment in 90 days. If they don't make the payment in 90 days, they're already 90 days late, in theory. And now another 30 days is 120. The likelihood of them being able to catch up is very low. I think the frequency of payment is important too. The frequency of payment, the more you can pay faster is the better for both the lender and yourselves, because it helps you manage the cash. It knows that today I'm taking 25% of your sale, whatever's left in your bank account, you can spend however you want. You don't have to worry about just putting a little to the side to when the payment is due, remembering when the payment is due. If you use these tools in the right way, it's very important. And the same thing goes for invoice discounting. When someone in the peer-to-peer lending space does invoice discounting, they're expecting that third-party payer to pay within a specific time. So they're also underwriting duration risk of, am I going to get paid on time from the third party? While the credit risk is lower because the counterparty is not an SME, it's probably a large organization. The question comes up, when will they pay?
Yeah, no, and I think your emphasis on data is really important for that as well, is being able to, initially onboarding the customer, but then monitoring the customer's payments as well. What sort of alternative data sources do you use? You mentioned, for example, restaurants, right? Looking at their Google rating rating to see how good they are as a restaurant. Are these the sort of alternative sources? If you could just allude to some of the examples.
Yeah, I think the Google Maps is very important. While you're working in a very digital world, you don't have that face-to-face contact relationship with your customer that you're accustomed to have historically. So you need to use these data sources, right? You want to know if the guy's paying his suppliers on time. I think we've been looking at Google reviews for a long time. In some instances, you read some of the responses that the customer has been shut down for 2 months. The customer is not paying his suppliers. And in other instances, you see people that are very happy with the services, are very friendly. You can also gauge whether or not he's pricing his products correctly. A lot of people complain that the price of this guy's furniture or that guy's furniture is too expensive, etc., or that the location isn't a very good location. So you get a lot of this feedback, and all of this is then driven to how we're going to get that information. Additionally to that, the government offers a lot of resources, right? So you want to look at the size of the building, and if you look at across, let's say, bakalas across the entire kingdom, you'll see bakalas that are operating within gas stations versus bakalas that are operating in smaller neighborhoods, and the size and the revenue generated per square meter of those, and see who the outliers are. Because with AI and machine learning models, is sometimes the best indicator is anomaly detection. So a lot of these things will show that certain data points that are being shared are anomalies, right? So when you look at anomalies, you can then decide, is it a good anomaly or a bad anomaly, and why do they have this anomaly? So it's not just giving a probability default score, it's whether the data makes sense into the extent of a business.
And just on that point in particular, do you feel that the data is structured in the right way to be able to use things like AI and machine learning to make those decisions, or are there challenges around the data itself, or using that data in Saudi specifically for AI and ML?
No, if you get the data from, it's not manually, and a lot of fintechs are doing this. If you get the data through APIs from different resources, whether it's GoSee, whether it's the Ministry of Commerce, whether it's Zakat and VAT, right? So we look at, for instance, now that VAT's been launched, we look at their VAT invoices and their VAT filings, right? To validate sales information, to validate certain key components of what the market is doing in that sense.
Okay. One question we've been asked a lot is around Sharia compliance. I know Ireda does a lot of financing on Sharia compliance. Could you just talk a little bit about how the financing is structured so that it is Sharia compliant, particularly given what we talked about around the high interest rates and things like that?
Yeah, so when you look at it, we don't look at it from an interest rate perspective. We're looking at it sort of the basis of Sharia compliance is shared risk. So we're looking at shared risk models. So when I tell you if you're making more revenue faster, we get paid back faster, that's a shared risk model. When you look at people paying slower and we're getting paid back slower, that's a shared risk model, right? So we have two forms of financing, either through musharaka, which is shared risk, or murabaha. So the structure of that of those financings are in those two forms, and it's worked very well for us. Obviously, we're 100% Sharia compliant. All of our products have fatwas issued by our local Sharia committee, and we go through quarterly reviews. But bringing products, so you can't just lift a product from the West and bring it to Saudi. There are some structural differences that you need to put in place to make sure that they're Sharia compliant.
Great, thank you, Paul. I'm just going through the questions. We've got a lot of questions now. We're at 152. So one question which we're getting asked quite a bit is around, I think this is from entrepreneurs who are looking to come into the market or looking at SME finance. What advice would you give to somebody who's looking at this as the opportunity? There's massive growth in SMEs. There's a clear need for finance. What advice would you give to someone starting out? And where do you see the particular opportunities in SME financing?
So, as an SME or as a financing entity?
As a financing entity.
So I think initially it's so the requirements for SME financing is high, in the sense that there are capital requirements from a regulatory perspective. I think the best bet to start on an SME financing journey is probably, if it was me, I would start somewhere into the peer-to-peer lending space. There's a lower barrier to entry. However, it is higher risk. Also, the other thing you can look at is not necessarily setting an SME financing company up. So the CMA has launched direct and indirect funds. So the ability that funds in the CMA can actually provide financing to SMEs. While you don't have to set up the full operations of operations of an operating entity like Al-Raida and the others, what you can do is you can set out the credit criteria that you want. You can raise the funds within the fund. You don't have to go out to every SME customer, but you allow the financing companies who want to enter the fund to deliver to you the assets that you want to finance for SMEs. That is a much more efficient process and scalable process. So you don't carry all the operational costs. You carry the risk of the loan, but you don't carry all the operational costs associated with it. And we just signed an agreement yesterday with one of the CMA companies to launch a 300 million real fund for SMEs in this nature for the fund's balance sheet, not our own.
And if we're to look at opportunities supporting finance, where do you see the opportunities for somebody who wants to develop something in this space but may not necessarily want to lend to SMEs? They want to support the sort of ecosystem.
So if you look at the things that we struggle with KYC. KYC doesn't sound that exciting, but there's a huge opportunity in validation of individuals in the lending process. And it's very regulated, and it is a necessity for all financing companies and all banks to do that. I think the other opportunity is around supporting services. So sometimes you have around collections, around also analyzing data. So data is a very important part of the SME piece. I think some services and some technology are lower barriers to entry to start that journey. If you look at Square starting off with ECRs themselves and just doing electronic cash registers, it gives you a plethora of data, right? Data analytics is very important too. So all of these services and more services are going to be needed, right? When VAT was issued, a lot of invoicing for VAT and stuff like that. So new things come and become important as the ecosystem grows and expands.
Great. And so Scott asked, what is KYC? So KYC is know your client. So how can you make sure that you're lending to the right person, that you know that they have got the right background and the right history to that, to avoid to reduce the amount of fraud?
Yeah.
I know we're short on time. We've only got a couple of minutes left. I guess my final question is, if I'm here, I'm very excited about what you've said about the opportunities in SME finance in the kingdom. Where can I go to learn more? What can I do to get more engaged into this space?
So definitely, this is easy. Go to Fintech Saudi. Secondly, I think, listen, setting up the SME Authority or Moonshot is a very good place to go. They have events all the time. It's called BBEN. You can not just meet financing companies, fintechs. They have entrepreneurial programs. They have training. They have mentorships, etc. I think that's very important too, to be involved and engaged. There's other organizations as well. And some of them are very specific. So like the Tourism Authority, the Agricultural Authority, it just depends on what industry you're interested in, what industry you're in. There's a lot of resources, and I think there's a lot of untapped resources. I think there needs to be a more widening understanding of all of these resources that are available to SMEs and to entrepreneurs to support these businesses.
Fantastic. Well, thank you very much again for your support and for answering so many questions. I know